Those that are joining online, just confirm if you can see my screen. I'm now sharing my screen. Just confirm, is my screen showing from your side?
Confirmed.
Okay, so welcome to today's session. Today we are continuing from where we left in the last session. So in our previous session, we did talk about accounting for sales tax. If not mistaken, we did look at how we account for sales tax. So we did talk about the sales tax control account, the journal entries for sales tax. We did also mention that we can have tax that is, we can have an amount inclusive of sales tax. We can also have an amount that is exclusive of sales tax. So in today's session, we are now moving to inventory, that is IAS 2. So let's get started. So today we want to look at how we record inventory. So inventory is recorded in accordance with IAS 2, that's International Accounting Standards 2. Remember when we started, we did mention these international accounting standards. We say that these govern how we record transactions. Remember when you talked about the IFRS Foundation, for those that were in, but in accounting, we have these standards that govern us on how we record transactions. So IAS 2 is a standard on inventory valuation. So inventory valuation. So maybe I might be having those that are hearing this for the first time who doesn't even know what inventory is. So inventory, we are looking at inventory are the goods awaiting sales or production. So we can have inventory of raw materials. These are the goods that are waiting to be used in production. So the inventory, these are the common inventory we're going to be dealing with is the inventory of goods that are awaiting sales. So we can have inventory of raw materials. So the inventory of raw materials, these are the goods that we are planning to use in production. So the common term is stock. So inventory is the same with stock. So the inventory can be inventory of material that you want to use in production. Then also inventory can be inventory of work in progress. If it's inventory of work in progress, this is inventory of goods that are semi-finished. These are goods that are still being processed. These are goods that are still in inventory. They aren't ready for sale yet, but these goods are now there in the organization. They are partly done. So we can call them work in progress. So we can also have inventory of the goods that we are still processing, that is work in progress, inventory of the material. We can also have inventory of finished goods, which is the one that we are going to deal with mostly. Inventory of finished goods. So these are the goods that are ready to be dispatched to our customers. So the finished goods, they are ready for sale. If you're looking at the finished goods, these ones will be ready for sale. So what does IAS 2 say? IAS 2, this standard tells us how we value inventory, in particular, inventory of finished goods. So the standard tells us how we are supposed to value inventory. So the standard says that inventory should be valued at the lower of cost and net realizable value. That is the requirement of IAS 2. Inventory, when you have inventory in the business, the value of that inventory should be lower of cost and net realizable value. So you have inventory in your books, but how much is that inventory worth? The inventory is valued comparing two things, the cost and the net realizable value. So if you have your inventory, you have your units in business. Let's say you have 100 units. You have 100 units. So what is the value of these 100 units? You compare two things. How much is the cost for these 100 units? How much is the cost? If the cost is 200, how much is the net realizable value? So the net realizable value, this is what we are going to get from the inventory. If we are to sell it and we deduct any cost of selling it, what is it that we can get from the inventory? If we can get 300, if we sell the inventory, we get 300. There are 100 units. We bought them at 200, but we're expecting to sell them at 300. So when you're valuing inventory, you take the lower of the two. In this instance, you value the inventory at 200. So the inventory is valued at 200, which is the lower. Let's put a dollar sign to indicate this is money and those ones are units. So when you're now valuing, the inventory is valued at $200. Why? Because it is the lower of the two. 200 because it is the lower of cost and net realizable value. So it is the lower of cost and net realizable value. Now, let's move on. When we say we should value inventory at the lower of cost, what is cost of inventory? What constitutes the cost of inventory? So what constitutes the cost of inventory? So we have inventory in the organization, but what makes up the cost of that inventory? So let's look at what constitutes the cost of the inventory. So what constitutes the cost depends on two things. Have we produced the inventory on our own, or did we buy the inventory? There are two things that can happen. You can either produce to sell. You're a farmer, you're producing and you're selling, or you can buy and sell. So if you are producing to sell, what constitutes the cost of inventory? The cost of inventory, we look at the production cost. That is the material, we can say the direct cost of production. And the factory overheads associated with the production. We can just say indirect costs of production. So if the inventory is produced in-house, the cost of inventory is the cost of production. How much did you spend to produce the inventory? That is the cost of the inventory. If you are producing the inventory in-house, the cost is the cost of you producing that inventory. But in some cases, we don't produce, we buy and sell. If you are buying the inventory, the cost of the inventory, we have the purchase price. We have any carriage costs. Any carriage cost, any duty on the inventory. So these costs, they are part of the cost of the inventory. So the cost of inventory, these are the costs we have incurred to bring the inventory to its present location. These are the costs incurred in bringing the inventory into the business. So if you have produced, it means you have incurred the cost of producing to bring the inventory in the business. If you have bought the item, there are costs of buying that you have incurred to bring the item to the business. So the cost we are looking at what you have suffered to bring the inventory in the business. So remember, if you have inventory, you need to value it at the law of cost and what? Net realizable value. So what about the net realizable value? The net realizable value, we can call it NRV. So the net realizable value, if we are looking at the net realizable value, this is what we are expecting to get. The net realizable value is what we are expecting to get if we are to sell the inventory that we have. What is it that you're expecting to get as our benefit or as our profit? So this is what the organization expects to receive after it has what the organization expects to receive after it has sold the inventory and deducted the cost of sales, cost of selling the inventory. So we can say the net realizable value is equals to the selling price, what we are expecting to sell the inventory for, the selling price minus the selling costs. The selling costs, these are the costs we are going to incur in order to sell the inventory, such as we might need to pay an agent to help us sell these units. So the net realizable value, we are saying, if we sell the inventory minus the cost of selling, what is it that we remain with? That's our net realizable value. So inventory is valued at the lower of cost and net realizable value. Inventory is valued at the lower of cost and net realizable value. Okay, let's move on. So we're going to have an example. KD Limited. KD Limited has the following items in inventory. Has the following items in inventory. So these are the items we have in inventory. Then from this, we can also be given the unit cost. Can be given maybe the purchase price, the unit, can be given the selling price, can be given the carriage cost, inwards. We can have the sales agent's commission. So these are unit costs. This data that I'm now providing is per unit. So you can say unit costs. So the purchase price, let's come up with maybe, let's say 25, this one 20, this one 19. Then the selling price, this one 35, this one 40, this one 48. Then the carriage cost, this one 10, 5, 12. Sales agent's commission, this one 8, this one 10, or we can say for this one, let's say 5. Then for this one, 15. So then the question is, what is the value of closing stock? So at the end of the period, we have units of X, of Y, and of Z. Now, what is the value of closing stock? So when you're determining the value of closing stock, the first step is to determine which one is the lower of cost and net realizable value. So remember, inventory is valued at the lower of cost and net realizable value. That is the first thing. Inventory is valued at the lower of cost and net realizable value. So let's first of all compare which one is the cost and which one is the net realizable. Sorry, which one is the, yes, let's come up with the cost and net realizable value figures. So the cost, remember I said cost, you say the purchase price plus any carriage cost. So for the cost, you can say the purchase price plus carriage inwards. So for our cost, we can have the 35. We come here for the cost, you can say the purchase price plus any carriage cost, 5. Come here, the cost, you say the purchase price plus any carriage cost. We get our cost. So the cost, it consists of the purchase price plus any additional costs you have to pay to bring the inventory to the businesses. So for the costs, we are adding the purchase price plus any carriage cost that you have to pay. So for the cost, you're saying the purchase price plus any carriage. Then the net realizable value of inventory. The net realizable value, we said, is the selling price less any selling cost. So the net realizable value, let's start with this one. For X, the selling price, which is 35, minus the selling cost, which is 8. So the selling price minus the selling cost, we get our net realizable value. We come to this one, Y. We again calculate our net realizable value. You'd say the selling price for Y, that's 40, minus the selling cost. The selling cost is the sales agent's fee there. So we remove the selling cost. We get our net realizable value. We come to the last one. We again say for the last one, the selling price, that's 48, minus the selling cost, that's 15. So we can get our net realizable value. So our net realizable value, it is the selling price less any selling cost. So for the net realizable value, it is the selling price less any selling cost. So now we have the cost and the net realizable value. What is the rule? The rule is we value inventory at the lower of cost and net realizable value. So you compare these two. Which one is the lower? You take the lower, which is 27. You compare cost and net realizable value, and you take the lower. 25 and 35, the lower is 25. You come here, you compare 31 and 33, the lower is 31. So you take the lower of cost and net realizable value. Then what is the value of your inventory then? So the value of your inventory, so for the value of inventory, we then say each unit for the 150 units that we have, each unit is being valued at 27. So you multiply. We take the lower of the two. We come here, we say we have 200 units in inventory, but we value them at the lower of cost and net realizable value, which is 25. We come here, we say, okay, we have 240 units, but we value them at the lower of cost and net realizable value, which is 31. So overall, the value of our inventory, we then add up the 4,050, the 5,000, the 7,000. So it means the value of inventory is that. Overall, that's the value of inventory. So what is the guiding principle? We value inventory at the lower of cost and net realizable value. We value inventory at the lower of cost and net realizable value. Even if the inventory was given in total, they can say for product A and product B. Then they say cost. $40,000, $60,000. Selling price, $42,000. 42,000. Then we can be given, oh, it's not, let's say 4,200, not 42. Then we can move on to this one. We can say 6.5. Then they can say that the sales agent is paid a commission of 10% on every item sold. The sales agent is paid a commission of 10% on every item sold. So the sales agent is paid a commission of 10%. So when you're now determining what is the value of your inventory in this case, it's the same principle. You just compare your cost and your net realizable value. In this case, we have for A, let me just copy this table. So it means the cost in this case is not changing, but the selling price, we have to come up with our net realizable value. The question is saying that the sales agent is paid a commission of 10%. So the commission is a selling cost. It reduces the selling price. So we are going to have the net realizable value here. So our net realizable value, it will be the selling price minus the selling cost. So in other words, we are saying 4.2 minus 10% of 4.2. 10% of 4.2 is 420. We again come here, you say 6.5 minus 10% of 6.5. 6.5 minus 10% of 6.5 is 65, 650. So now you have your net realizable value. Then your inventory is based on the lower of the two. You compare cost and net realizable value for A, the lower is net realizable value. You take that one. Come for B, the lower is the net realizable value. So it means you first of all have to adjust your selling price to get the net realizable value. Then inventory is valued at the lower of cost and net realizable value. Inventory is valued at the lower of cost and net realizable value. Inventory will be valued at the lower of cost and net realizable value. Now, let's move on. Inventory valuation methods. Inventory valuation methods. Inventory can be valued using inventory can be valued using the FIFO, the LIFO, or the ACCA method. Inventory can be valued using the FIFO, LIFO, and AFCO method. The FIFO method is the first in, first out method. First in, first out method. The FIFO is the first in, first out method. The assumption behind FIFO is when we sell inventory, we start by the goods that came in first. So if it is the FIFO method, the assumption is the goods that came in first are the first to be sold. That is the assumption under FIFO. So the goods bought first are the first to be sold. That is the assumption under FIFO. The goods which you bought first are also the first to be sold. The goods which came in first are the first to be sold. The goods which were bought first are the first to be sold. So I think this is more practical. In most organizations, when you buy, you start by selling what you bought first. Let's think of you selling bread. You can't start selling what you bought, what you ordered today before you clear the yesterday's batch. So you start by clearing the goods that came in first. That is if you're using FIFO method. LIFO method is also there, but this one, we are not going to deal with it because it's not practical. So it tends to have issues that it's not recommended. So LIFO, this is last in, first out. Last in, first out. Last in, first out. So this assumes that the goods that came in last are the first to be sold. So let's think of it as a warehouse with only one door. You are loading your things in one warehouse with only one door. So what would happen is when you're now selling, the last goods you pegged in are the first that you can collect. So if it is LIFO, we are saying the last goods in are the first ones out. So this assumes that the goods which were last to be bought are the first to be sold. So the goods which were last to be bought are the first ones to be sold. That's LIFO. Then besides LIFO, we have AFCO, which is the weighted average cost method. It's the weighted average. Is the weighted average cost method. This is used when maybe we can't tell which goods came in first and which ones came in last. So for this one, it uses the average. Okay, say this uses the average. The average cost. This uses the average cost. Okay, so let's have an example. Let's exemplify this. Let's exemplify this. Okay, so you started with your opening inventory. You started with your opening inventory, and in stock, you sold 500, you had 500 units, and you had bought each unit at $5 each. Then on 5 January, you made purchases. So your purchases, you bought 600 units. $600 units at $6 each. Then 10 January, sold sold. So for 10 January, we can be told that sold 150 units. So we bought 500 units, or not 150, let's say 550 units. Sold 550 units. So the question is, the units that you are remaining with, are they of $5 or are they of $6 each? You bought these units at different prices and you sold 550. So your remaining inventory, is it inventory of $5 or is it inventory of $6? So this is where FIFO, LIFO, ACCA comes into play. So if the assumption is we are dealing with FIFO, FIFO would say, when you sold 500 units, 550, you first of all cleared the batch which came in first. So if we are using FIFO, the assumption is when you sold, you had inventory bought on 1 January of 500. So when you sold, you cleared that first. So you cleared that 500 units, meaning you remained with 0. Then the next day, 5 January, you bought 600 units. But since you sold 550, you first of all cleared the 500, the first batch. Then to make them 550, it means you took only 50 from this batch. So if you're using FIFO, FIFO would say that you cleared first. If it's FIFO, it would say you cleared first the batch which came in first. So it means now you have 550 units of $6 each. So the value of inventory would then be value of inventory. Value of inventory would then be 550 times 6. That is if you are using the FIFO method. What about if we are using, so this is the FIFO. Let me just drag this down a bit. So this is the FIFO method. That's if we are using the FIFO method. Then besides the FIFO method, we have the LIFO method. This one, we are not going to discuss much about it. This is the last time. Maybe I'm going to demonstrate it any further because this one, they won't ask you much about that. Because FIFO, it undervalues inventory. So if it's FIFO, how is it different from LIFO? So for FIFO, for LIFO, This is how we would assume the inventory was distributed. So if it is LIFO, would say, no, we clear the batch which came in last first. So if it was LIFO, you'd say the 550 units, you take them from the batch that came in last. So you are taking them from here because you have 600 units, so they're enough. So you can take them from the last batch. So if it is LIFO, you first of all issue from the last batch. So meaning that this would mean we are remaining with 50. And it would mean for this one, we still have 500 units. How then would we value inventory? So for the 500 units, you'd value them at their cost, which is 5. Then for the 50, you'd value them at their cost, which is 6. So it means if we are using LIFO, what then would be the price of inventory? So if we are using LIFO, the value of inventory would then be 2,800. That is if we are using LIFO. Then let's assume these are liquids. Let's say 1 January you had 500 liters, and 5 January you again bought 600 liters, and you're pouring them in the same tank. If these are liters and you're pouring them in the same tank, you can't tell the liquid now that I'm selling is from which batch because they get mixed up. So in such kind of an environment, we might say, let's just work with an average price. Let's add up. We bought 500 and 600. So altogether, we bought 1.1. Then we sold 5.5. So we are left with 5.5. But the value of those units, we just come up with an average cost. That is if it's AFCO. So AFCO, this uses the average cost. There are two approaches to AFCO. So AFCO, it has two approaches. There are two approaches. There are two approaches to AFCO. These are we have the first one, which we call the periodic AFCO. We have the periodic AFCO and the continuous AFCO. So the AFCO can be the periodic AFCO or the continuous AFCO. The AFCO, we can have the periodic AFCO or the continuous AFCO. So the AFCO, we can have the continuous AFCO or the periodic AFCO. Now let's have, let me come up with a question where we are going to demonstrate FIFO, AFCO, using the periodic AFCO and the continuous AFCO. But before we get to that, let me just highlight this NB point. Important point to note. Important point to note. Important point to note. Just a moment. Just a second. Okay, let's move on. Sorry for that. So important point to note. So if prices are rising, FIFO reports higher prices. If prices are rising, FIFO reports higher profits. If prices are rising, FIFO reports higher profits than AFCO. If prices are rising, FIFO reports higher profits than AFCO. And when prices are falling, it reports lower profits. If prices are falling, it reports lower profits. Prices are falling, it reports lower profits. Then let's move on. Example, using FIFO, periodic AFCO, and continuous AFCO. So example of using FIFO, AFCO, and continuous, periodic AFCO and continuous AFCO. FIFO, periodic AFCO, and continuous AFCO. So we can be told that KD Limited had the following information for the month of January. Calculate the inventory values under the above methods. So 1 January, we started with opening inventory. We started with opening inventory of 1 January. We started with opening inventory of 450 units at 450 units at $3 each. So it started with opening inventory 450 units at $3 each. Then 5 January, bought so 5 January we bought 200 units. We bought 200 units at 350 each. Then the next date, 8 January. Sold 300 units at $6 each. January, bought 220 units. Bought 220 units at $4 each. Bought 220 at $4 each. Lastly, let's say instead of 12, let's say 20 January. Sold 200 units. So 200 units at $8 each. So we want to work out the value of inventory. We want to work out the value of inventory. The first method we are going to deal with here is using, so we want to work out the value of inventory. Firstly, we are going to use the FIFO method. So we're going to start with FIFO, using the FIFO method. Using the FIFO method. So if you are using the FIFO method, the assumption is the goods that came in first are the first to be sold, remember. So I prefer to use this table. You start with your date. If you are using FIFO, there are different ways of doing it. You start with the date. So we start with the dates for the purchases. We are taking the dates for the purchases. Opening inventory, you just treat it as the same with purchases. So you start with the dates for the purchases. We have 1 January, we have 5 January, and the other date for purchases is what? 12 January. So you start with the dates for the purchases. You start with the dates for the purchases. Then after the date, you put the price. The price. So the price for the purchases, you're taking the price per unit. For 1 January, you were buying at $3 each. The next date, 5 January, you bought at $3.50. 12 January, you bought it $4. Then we move on, the quantity. The quantity, this is what we bought. The quantity we started with is 450, that's 1 January. Then 5 January. For 5 January, we bought what? 200. For 5 January, we bought 200. Then for 20 January, 12 January, we bought 220. So what was I doing here? I just took the purchases. The date we bought the purchases, the price, the unit, and the quantity. And I arranged them horizontally. So then you start putting the issues here. So the issues, these are the sales we made. So we start with the first date of sales. When did we sell? The first date of sales is what? The first date of the sales? 8 January. So that's 8 January. So now we are applying the FIFO approach. So if we sold on 8 January and we sold 300 units, which batch would we subtract from first? It's the 450 batch. So the 300 would be taken from this batch. So you'd subtract the 300 under the first batch bought on 1 January. So using the FIFO method, it means how many units would be remaining for this batch? It would be 150. So we sold on 8 January, we sold 300. So for that batch, we would remain with 150. Then the next day of sales is when? Or let's reduce this. It's not supposed to be 2,000, it's 200. I wanted to put 200. So the next date of sales is 20 January. So we sold 200. But we can't remove 200. We can't remove 200 from 150. So it means we just, from this batch, you just take 150. Please pay attention to this part. So you take 150 from this batch, but your customer wants 200 units. So the other 50 you take from the next batch. So now we have issued the 200 units. So you first of all clear the remaining 150 from this batch, meaning for this batch you have 0 remaining units. Then for this batch you remain with 150. Then for this batch all your units will be still there, 220. What is then the value of inventory? We are done with the dates, so the value of inventory. So determining the value of inventory is then supposed to be a bit easy. So the value of inventory for this batch, we no longer have any units. So for this second batch, we have 150 units, of which the price per unit was 350. So you say 150 times 350 plus for this batch, you have 220 units at $4 each. So 220 at $4 each. So the value of inventory will be 150 times 350 plus 220 by 4. So this would be the value of closing inventory using FIFO. That would be our value of closing inventory using FIFO. Okay, so this was using the FIFO method. Then let's move on. From FIFO, let's move to the next one, which is AFCO. But for AFCO, remember we have two. We have the periodic AFCO and the continuous AFCO. So let's start with the periodic AFCO. The periodic AFCO. So for the periodic AFCO, if it is the periodic AFCO, what you first of all need to do is to, again, the same way we start with the purchases. So the first date of purchases, you just take the date of opening stock, which is 1 January. So for 1 January, how many units did we buy? So you put units this side, then you put the value from there up. So it's 450. We need the value in total. It was 450 at $3, right? So you have your total there. So these are the units. This side is the value. We have the units and we have the value. Then the next date of purchases, we are still dealing with purchases. What's the next date for purchases? It's 5 January. So how many units did we buy? 200 at 350. So the value would be 200 times 350. The last day, I think that's, what was the last date? 20, I think it's for sales. For purchases, 12 January, we bought 220 and the price is 4. So we bought 220 at $4. I think we're done with the purchases. So AFCO, we first of all want the average. So we're saying for all the units we bought, if we add up the price for all these units. So the AFCO is saying all the units, if we add up what we used to buy all these units, you're going to get that's 1350 plus 700 plus 88. So if we add up all that we used, it's 2.930. But how many units did we buy in total? So we also add up the units we bought in total. So we bought 2.930 and we bought at 2,930 and the units are 870. So we then work out our average cost per unit. Our average cost per unit. So average cost per unit, you say the total value over the total units you bought. You get your average cost. And round to 2 decimal places there. So it means on average, each unit you bought it at $3.37. On average, each unit you bought it at $3.37. Then after that, we work out the closing inventory. We work out the closing inventory. So closing inventory. Yes.
I think kwangu similar rasipa nakuona kuti 3.37 yoma mwana says.
Okay, Tatisusu total value 2,930 divided by total units. So it means my units is set amatenga 2,930. And my units are actually 870. So on average, each one tatenga nemari, you divide 2,930 divided by 870. That's how we got 3.37.
Okay, thank you.
Then tanga kusvaga okay, we bought 870 units in total, but how many did we sell? So firstly, we sold 300, and we then sold again 200. So you're just subtracting the units. You had 870, you sold 300 and 200. So how many units do you have? 870 minus 500. So it means now you have 370 units. So we have 370 units, but the average cost for each unit is 3.37. So now we can say the value of closing inventory, So to get your value of closing inventory, you are simply multiplying now. So you're saying the units that we have times the average cost per unit, 3.37. So that is if we are using the periodic AFCO, then you're done. So that's the value of our inventory. That would be the value of our inventory. So work out the average cost per unit first, then calculate how many units you still have in inventory. Then you multiply by the closing inventory, sorry, by the average cost per unit. Take note, the selling price doesn't affect inventory valuation here. So we are dealing with the cost. So this selling price, even if we consider the rules for IS2, the selling price is higher than, it's less likely for you to get a selling price lower than the cost. So we're just going to be using the cost. Provided maybe that the price is being provided being lower than the cost. But in this case, we actually have to determine whether is this batch or is that batch. So we can't tell which cost to compare with. So for inventory valuation using FIFO, AFCO, ignore the selling prices here. If you are dealing with the FIFO method, the AFCO method, the selling prices are not going to affect you. Okay, let's move on. So now we are moving to the last method. We are moving to the last method, which is the continuous AFCO. The continuous AFCO. So we have the periodic AFCO and we have the continuous AFCO. We have the periodic AFCO and the continuous AFCO. So we have the continuous AFCO and the periodic AFCO. Okay, so what's the continuous AFCO approach? How do we do it? So for the continuous AFCO, it's a bit long. So for continuous AFCO, we are going to need a table with dead. I'll just do halfway, then you finish up. So you need to look at what I'm doing so that you can be able to finish up the table. Of course, we'll do it together, but I will leave it halfway so that you can test your understanding. So debt, then we have purchases, then we have issues. Then we have balance, average, then balance. So now starting, now you can pay attention. So for the AVCO, the continuous AVCO, we just take the dates as they are. We are not starting with purchases, we are just taking the dates as they are given. So the first date is 1 January. What happened 1 January? Did we buy or did we sell? We bought. It was 450 at what? 450 at what? The price, $3. So under the issues, you put 450 at 3. The first column, you are putting the units. The first balance is in units. So the first balance is in units. So this balance is going to be in units. Then the second balance is in value. So the first balance is units. The second balance is value. The first balance is units. The second balance is value. So let's move on. After 1 January, the next date is so 1 January, the next date is what? 5 January. Again, we bought how many units? 200 at 350. So we add here, there's 200. This side is the value 200 times 350. So please pay attention to what I'm going to do here. After you have bought more goods, you come up with an average. So whenever you add more goods, you come up with an average. So 450 plus 200, you add this total. So continuous average means you are calculating the average continuously, unlike the periodic average. So after every purchase, you calculate the average. So you say this balance this side divided by the balance this side. So you're saying the balance on the side of the value divided by the balance on the side of the units. So you say 2050 divided by 650. Now let's move to the next date. After 5 January, what's the next date? It's 8. What happened on the 8th? We sold. So the sales, we put them under the issues column. For sales, you put them under the issues column. So for sales, we sold, how many units did we sell? Is it 300? Please take note here, pay attention, you write. So for sales, you multiply the sales at the last average. So for sales, they are made at the last average. So for this column, sales, you're going to subtract 300. You don't add this time in sales. Then for the value, you multiply sales with the last average. For the sales, you multiply with the last average. For the sales, you multiply with the last average. Then you add. For the sales, you multiply with the last average. So for sales, there is no need to average, but if you want, you can still average here. So if you average for sales, it's not supposed to change. It is supposed to remain 3.15. I think it's just an issue of rounding off here, but supposed to remain 3.15. So after that, let's move on. The next date is what? 12. What happened on the 12th? 220 at what? 4. So these are purchases you are adding 220. This side you are adding the value, those 220 by 4. Just a moment. So after we've made the purchases, we then come up with our total. That's 350 plus 220. Come here, we do the same. Then after the purchase, remember, we come up with the average. So 1985 divided by 570. And let's move on. The next date after the 12th, The 20th of January. What happened on the 20th of January? How many units? So I'm supposed to say 200 at what? Are you sure? It's average. So remember, for the cells, we make them at average. So for the cells, you multiply with the last average. Okay, so we're done. So under continuous AF is the inventory value is 1,289, and the units we have 370. So now let's go to the questions. Let's go to your kit so that we can look at the exam type questions and you can try. So now let's go and look for what we've been discussing from the questions. Let's start with this one. Can you quickly try this? So what was the value of inventory at the year end? What was the value of inventory at the year end? So can we quickly please finish that? Okay, I think you're done now. What are you getting is your value of infantry. Let's be fast, we have other things to come. Have you forgotten already how you were doing it? Okay, 4.7 from Dockers. Others, what are you getting? Okay, so 4.7 again, another confirmation there. Let's quickly do it together and see how you're supposed to do that. So the original cost is given, the selling price is given, the selling cost is given. We don't have any carriage cost or any other cost that can be part of the cost. So I think what we need is the net realizable value. So net realizable value, we can say the selling price less selling costs. So for the first one, our net realizable value, for the first one, our net realizable value, I think for the first one, the net realizable value is 8. So 9 minus 1 there, I think this one 8 can do. Okay, so for the first one, the net realizable value is 8, 9 minus 1. Then for the second one, the net realizable value, 12 minus 4, again, this one should give us a net realizable value of 8. Okay, so our net realizable value there is going to be 8. Then we come to here, 15 minus 5. Our net realizable value is 10. So we compare the cost and the net realizable value. These are the cost figures. Compare the cost and net realizable value. So for basic, the lower is the cost. So you say 6 times 200. Then for super, the lower is 8. So you say 8 times 250. Then for luxury, the lower is 10. 10 times 150. So you first of all get the lower of cost and net realizable value. After you get the lower of cost and net realizable value, you then multiply the units with that lower of cost and net realizable value. So to value your inventory, you multiply the units with the lower of cost and net realizable. One more question to try on this concept. Let's try question 110. Let's try question 110. So quickly, please, let me give you a minute more. Okay, so can I have the answer now? The answers are there. Which one are you going for? Is it A, is it B, is it C, or is it D? Or it's all of the above? Okay, Dorcas is coming in with an A. We also have another A.
A.
Okay, A, I guess, is winning. So what do we have to do here? From the selling price, you have to remove the commission. Then you get your net realizable value. So you then compare the cost and that net realizable value. So you come to 2.9, you subtract 4% of 2.9. Come to 4,000, subtract 4% of 4,000. Come to 1.3, subtract 4% of 1.3. Then you compare the cost and the net realizable value. So without wasting much time, okay, here is FIFO, 111. Can you try FIFO? What is the value of closing inventory using FIFO? It's not a test. You can even refer back to what we were doing. quickly finish up that.